There's a lot to unpack, but I did want to start with one article on the Bloomberg terminal that said that empty dorms are putting pressure on U.S. colleges to help investors in the approximately $14 billion student housing debt market. But you like the space.
Yes, we do. First of all, to clarify, we invest primarily in large public university markets with enduring demand growth and limited supply, so places like UT Austin, University of Alabama, University of Michigan. Interestingly, I think the best example is we brought two properties online in August of this year, one at Rutgers in New Jersey, one at the University of Florida in Gainesville. Both of those properties are close to 100% leased and occupied, because even though Rutgers is fully remote and UF is on a hybrid model, the students are honoring their leases, showing up, and they don't want to live in their parents' houses anymore. And I would say their parents probably don't want them living in their houses anymore either. So in certain university markets, for a certain portion of the student housing market, namely the high end, we very much like the dynamics here and going forward, as you will have supply constraints, no surprise, on a going forward basis, as debt capital is much less available than it had been pre-COVID.
Al, looking forward, therefore, what kind of yield can I expect off this sector?
Well, in terms of our investment, we're looking at both development deals and acquisitions in the university markets that I mentioned. I think, we've seen pricing change anywhere from 5 to 20% from pre-COVID levels, and this is for higher-end, high-quality, institutional-grade assets. And that is a very material change, and one in which we certainly expect to be able to exploit the opportunity in front of us.
But talking about other opportunities, senior housing you're also into, and that's luxury senior housing, but that area has gotten so hit. Walk me through how bifurcated the sector is, what kind of returns you're looking at, occupancy rates, where are you with that sector?
Well, in our opportunistic strategy, we continue to look at above 20% gross returns for seniors housing. I think that, obviously it's been covered in the press and gotten a negative slant. High-end senior housing, which is private pay, and we invest only in really the top 50 MSAs in the U.S. or metropolitan statistical areas. We're looking at independent living and assisted living, all private pay, so no Medicare, Medicaid, or insurance reimbursement risk. Interestingly, our portfolio is only down about 3% in occupancy, with virtually all of that having happened between March and June. We've actually had occupancy gains since July 1. We think the senior housing sector, the high end of it, is actually better positioned post-COVID than pre-COVID, in that demand endures. You have tremendous demographic tailwinds, and the quality of care is really unparalleled. So what we expect is post the operational intensity and difficulties that we're experiencing now, but really from this point looking forward, but even more so from a year out from now looking forward, that seniors housing is incredibly well positioned, primarily because you've got, as I said, demographic tailwinds, and you're going to have very significant limitations on new supply. So, one example is a property that we just brought online in Brooklyn Heights, New York. Tremendous demand, 275 units, really unparalleled in terms of quality, unencumbered views of lower Manhattan. There are 4.5 million people in Manhattan and Brooklyn, and I would say there are only approximately 3,000 units of high-end senior housing available. So it doesn't take much to kind of do the math on that.
Al, in terms of investors into this space right now, pension funds obviously are a pretty big player. They've moved into student housing significantly over the last few years, and senior housing as well. How much demand are you expecting to see from that kind of investor going forward, given the fact that interest rates are likely to remain on the floor for some time?
Yeah, I think that investors, we've seen an inflow of investors into healthcare real estate and in particular student housing, actually so much into student housing since 2013 that we've been a net seller in the space over the past 7 years. We've reversed that now post-COVID as we've seen prices change. But, healthcare real estate in terms of, a long-term strategic allocation from pension funds and other large institutional investors is going to be, is going to continue to see capital inflows. It's close to 20% of U.S. GDP. You've got very strong demographic tailwinds. You have a lack of correlation with the macroeconomy and other real estate assets as a whole. And as you mentioned, you've got relatively clear sailing going forward in terms of interest rates. So we see a lot of runway, and we continue to see interest and increased dollars flowing into all of these sectors, namely healthcare, real estate, and student housing.